Welcome back to the SaaT System Channel, where we break down the biggest geopolitical and economic developments shaping global capital flows. Today's episode covers one of the most talked about developments from the World Economic Forum 2026. In Davos, what is now being called the Greenland Framework. On January 21st, the United States announced a framework of a future deal involving Greenland and the broader Arctic region. No territory changed hands announced. No formal treaty was signed. But markets reacted immediately. Tariffs were canceled, European stocks surged, and commodity fears eased. Investors are now paying close attention because this framework signals something much bigger, a potential restructuring of Arctic security, critical mineral supply chains, and long-term capital deployment. Today, we'll cover what led to this moment, what the Greenland Framework actually means, how markets are reacting, and how strategic investors might position for what could become one of the largest resource and infrastructure cycles of the next 2 decades. Let's begin. So, why does Greenland matter? It's an autonomous territory of Denmark with only about 57,000 residents. But strategically, it sits at the center of 3 converging forces: Arctic military positioning, global critical mineral supply chains, and emerging polar trade routes. As the ice recedes, Greenland is no longer remote. It's becoming accessible. And beneath its surface are resources modern civilization depends on: rare earth elements, uranium, lithium, copper, nickel, gold, and massive untapped hydropower potential. Estimates suggest Greenland may hold 10 to 20% of the world's rare earth reserves. This is happening at a time when China currently controls roughly 80 to 90% of global processing capacity. This isn't about land. It's about supply chain sovereignty. In early January 2026, tensions escalated rapidly. The U.S. announced potential 10% tariffs on Denmark and 7 other European NATO nations. The justification focused on countering Russian and Chinese Arctic expansion and securing access to critical minerals. Rhetoric intensified, and markets responded violently. At one point, fears of a transatlantic trade conflict erased over $1.2 trillion from the S&P 500. Then came Davos. On January 21st, U.S. officials publicly emphasized cooperation over confrontation. Hours later, after discussions with NATO Secretary General Mark Rutte, the U.S. announced the creation of a framework of a future deal covering Greenland and the Arctic. Tariffs were immediately canceled. Markets reversed. Diplomacy took the lead. So, what exactly is the Greenland Framework? Details remain intentionally broad. It's been described publicly as a concept of a deal, long-term and strategic rather than transactional. Reports indicate it centers on expanded U.S.-NATO Arctic coordination, enhanced military basing, and increased mineral and infrastructure cooperation. Most importantly, NATO leadership emphasized clearly, Danish sovereignty over Greenland was not compromised. No sale, no annexation, no military takeover. This isn't a treaty. It's de-escalation plus positioning. And markets understand that signal. The immediate effect was uncertainty removal. Economists estimated that if the tariffs had gone live, global growth could have dropped by 0.5% to 1%. Instead, European stocks surged, Wall Street closed higher, and commodity volatility stabilized. But the deeper implication is strategic. If the framework evolves into structured cooperation, it could reshape critical mineral supply chains, Arctic logistics routes, energy development, and long-term infrastructure investment. This isn't a trade story. It's a capital cycle story. Greenland's entire economy is only about $3 to $4 billion annually, so this won't move U.S. GDP, but it may unlock trillions in global asset value over the next 10 to 30 years. Why? Because Arctic development requires massive infrastructure: ports, roads, airports, power generation, mining facilities, communications, and cold climate data centers. Even limited cooperation could trigger hundreds of billions in long-term capital deployment. That means opportunities for engineering firms, defense contractors, energy developers, mining groups, and infrastructure funds. This is how secular investment cycles begin, with geopolitics quietly opening new frontiers. Of course, this is not a guaranteed boom. Major risks remain, including environmental opposition, Greenlandic autonomy concerns, extreme operating costs, long permitting timelines, and political reversals. Projects here will require decade-long horizons, heavy capital expenditure, government backing, and immense investor patience. This is not retail speculation. This is strategic capital. For SaaT System investors, this isn't about chasing headlines. It's about building early awareness of sectors likely to benefit if the framework develops. Let's look at 3 key areas. First, mining and critical minerals. Rare earths drive everything from EVs and AI hardware to wind turbines and defense systems. Opportunities may emerge among strategic junior miners, U.S. aligned processing ventures, and strategic metal ETFs. This is the backbone layer. No minerals, no electrification, no AI hardware, no energy transition. Second, energy and renewables. Greenland combines offshore hydrocarbon potential with massive untapped hydropower and strategic shipping access. Energy security is geopolitical. Investors will likely watch for offshore exploration partnerships, hydropower infrastructure projects, and developments in co-region energy tech. This is where defense, climate, and capital meet. Third, infrastructure and advanced engineering. Every Arctic build requires specialized construction, ports, ice-resistant structures, subsea cabling, and military-grade logistics. This favors engineering conglomerates, defense-linked builders, infrastructure funds, and data center developers. These are the companies that build multi-year revenue streams. Longer term, we might even see niche plays in Arctic tourism, freshwater logistics, and satellite services. So here's the strategic takeaway. The Greenland Framework is not a deal. It is a directional shift. It tells markets that the Arctic is now a strategic theater. Supply chains are being redrawn, and resource security is now national security. This is how major investment waves start. Not with contracts, but with frameworks. The Davos de-escalation prevented a trade shock, but it also signaled the opening of a much larger Chapter 1 where capital, security, technology, energy, and resources begin migrating north. For investors, this isn't about immediate returns. It's about mapping where future capital will flow, because wealth cycles are built long before headlines catch up. If you found this breakdown valuable, subscribe to the SaaT System Channel for more geopolitical and investment intelligence. Visit SaaTSystem.com for our tools, analytics, and long-term strategy frameworks. Share your thoughts below. Do you see the Arctic becoming the next major investment frontier? As always, stay informed, stay strategic, and keep building long-term advantage.